Good afternoon. I can see people are now joining the webinar, so we'll kick off in about 30 seconds time just to allow a few more people to have a chance to join. So we'll kick off in about 30 seconds time. Okay, thank you for waiting. We're going to kick off now with our webinar on planning to sell your business, what you need to know about a trade sale. I'm Andrew Coates of Strategic Corporate Finance, and I'm going to cover the introduction and talk towards the end of the seminar about how we can help. Greg Barker will cover much of the content in the middle of the webinar. What we're covering this afternoon is a bit about us, just to explain why we're qualified to talk about trade sales. And then we're going to talk about, before you start the process, a bit about the process and how long it tends to take, a bit about pre-marketing and marketing, selection of a preferred buyer, and running up to closing the deal, completing the deal. So really taking you through the trade sale process, and just in this fairly short webinar, it tends to last about 45 minutes, this webinar, covering some of the key aspects of the trade sale process. At the end, we're very happy to answer any questions and to ask questions. I know some people prefer to email the questions. If you email the questions, that's fine, we'll pick them up. But it's better at this stage, now the webinar has started, to use the facility that's either at the top or bottom of your screen, depending on how you're viewing this webinar. There's a Q&A facility. If you ask your question there, we'll pick them up at the end and answer as many questions as possible. So just a bit about us, why we are able to, why we're qualified, why our expertise is in trade sales, why we're able to talk with knowledge about trade sales and the process. We've been going just over 20 years. We're in our 21st year, almost our 22nd year. And we're all chartered accountants by qualification, but left routine accountancy work behind many, many years ago and advised solely on transactional work. So we act for clients who are looking to sell their businesses, and that can be by selling their business through a trade sale, or it can be selling to a management team or a private equity organization. And we act for management teams looking to do acquisitions, and occasionally we act for corporate buyers in doing corporate acquisitions. So all our work is transactional, really allowing us to help clients achieve their aspirations. Clients who've worked in businesses for often 20, 30 years, sometimes not as long as that, and allow them to, get a financial settlement, get a good financial settlement when they sell the business. But also most clients are interested in the legacy of what happens to the business after they have departed from it. Most clients want to see the business continue in a similar form, with most employees keeping their jobs and the customers continuing to get a good service. So it can be quite an emotional time in selling your business and deciding to sell. And our expertise is to help clients achieve those aims and see them through the process. Because we do a lot of transactional work, we passionately believe that giving early stage advice is absolutely vital to clients. Most clients only go through a transaction once in their life. They haven't got experience of the previous transaction, and we are there to help open their eyes as to what can be achieved and the best way of achieving it. So we do a lot of early stage advice, such as providing valuations, commercial valuations of what we think a buyer will pay for their business. And because of our experience, the valuations tend to be quite accurate. We do work in assessing exit options. So we'll look at, for the client who's looking to sell their business, we'll talk to them about the pros and cons of a trade sale compared to a management buyout. What sort of value might be achieved through a trade sale? What sort of value might be achieved through a management buyout? How much cash should be up front through a trade sale compared to a management buyout? The options through a management buyout to sell your cake and sell a bit of your cake later, almost through retained equity, selling 100% now and 25% later. So we'll take clients, we'll give them the benefit of our experience and take them through what can be achieved through a trade sale and a management buyout. We run a seminar specifically on comparing trade sales with management buyouts and the pros and cons of each. So if you're interested in that, on our website, you can book into our next seminar that compares exit options. But once we've helped a client form a view as to the best exit route, what price they're likely to get for the business, And the timing of the sale is often quite important in terms of initial advice. And they decide to press the button and go forward with a sale process or a management buyout, then we can provide, and we do provide for most of those clients, we provide lead deal advisory services to take them through the transaction. We're not talking about MBOs today. We're going to concentrate for the rest of the seminar on talking about trade sales, selling your business to a trade buyer, a corporate buyer. And we'll go into this in detail, but a lot of it's to do with how to market your business. We prepare information memoranda that are the first impression most buyers get about your business. We do a lot of buyer research, international research, worldwide research to identify potential buyers. We approach buyers in a positive way, encourage their interest, get them into meetings, encourage offers, negotiate the offers, to get heads of terms, which in many ways, once we've agreed heads of terms with a buyer, that's the starting point. We've got the buyer, we know what the deal's going to be, and there's still an awful lot of work to get that over the line. Really enjoy what we're doing. The whole team enjoys working with clients and helping them achieve their aspirations. It's really satisfying work. But as we've shown on this slide, it takes a lot of effort. It takes a lot of experience, perseverance. Other strengths we've got are integrity, and we're independent, a small team who have worked together for many years and really passionately wish to get the best for clients and their businesses. We've completed well over 100 transactions over the years. So we've got a wealth of experience covering deals across many, many different sectors in the SME marketplace. So most of our transactions will have turnovers of £2 million up to £25 million, but an awful lot around the 2, 3, 4, 5 million pounds level. And we do act for clients below £2 million turnover as well. But the most common, the most sort of our the deals we deal with typically tend to be £2 million and upwards. But we're always happy to talk to smaller businesses and see if we can find a solution for them. So I'm going to hand over to Greg at this stage, who's going to take us through most of the technical content of the seminar, and then I'll come back in at the end just to talk about how we can help. And Catherine will join us right at the end to answer, to host the question section. But as I say, if you've got questions throughout the seminar, please just use the Q&A facility and we'll pick up on the questions at the end. Thank you.
Thanks, Andrew, for that introduction, and hello, everyone. So as Andrew's mentioned, I'm going to talk through the trade sale process, what's involved, and give you an idea of how we help clients with a trade sale. As Andrew touched on in the introduction, it's a very big decision for business owners to seek a sale of their business, and it's not something that ought to be sort of jumped straight into without a bit of thought beforehand. And a key part of the service that we offer clients is helping them understand whether they're putting their business on the market is the right thing, what they can expect to achieve from a trade sale, and what the different options are. So I've noted on this slide a few of the considerations that business owners ought to be thinking about when they start to plan for a sale of their business. And the first one, fairly obviously, is will a trade sale meet your price expectations? It's incredibly important to have a clear idea about what your business is worth and what sorts of factors drive the value of your business. And it's important to be realistic about that. We often see when we're working on the buy side for clients looking for acquisitions, we come across instances where businesses are put on the market, but the owners have unrealistic expectations about what the business is worth. And it can lead to a lot of wasted time and effort and money on all sides in that sort of situation. I'd also caution against free valuations. Sometimes you might come across websites offering free valuations, and for instance, you might be asked to select the sector that your business is in and perhaps enter your turnover or net profit, and it will generate a valuation. Those sorts of tools are extremely simplistic and not really worth bothering with. Also, if any if valuations are provided free of charge, you ought to be questioning whether there is some sort of inherent bias behind the valuation. Is the person giving the valuation trying to win an instruction to sell your business? Are they are they likely to inflate the valuation in order to secure winning a piece of work from you? We do regularly undertake valuations on behalf of clients to give them that knowledge up front before they make a decision about whether they want to put their company on the market and seek a trade sale. And we do charge up front for those valuations because it's important that those are done professionally, and they often take, well, they do take several days of time to produce and do a thorough and professional job. Equally important to the valuation of a business is how saleable it is. It might be that the valuation meets your expectations. However, there could be issues with the business that might make it difficult to sell. So I've bullet pointed some of those common issues that crop up from time to time. Size can be an issue. Smaller businesses tend to be less attractive to purchasers. Customer concentration is also another fairly common issue. If it's a business that is reliant upon a small number of very large customers, that can represent quite a significant risk factor for potential buyers and make a trade sale difficult. And probably the most common sort of issue we come across in the SME market is a sort of an undue reliance on the business owners for management of the business. And in those sorts of situations, it doesn't necessarily preclude a trade sale, but it might mean that the vendors need to remain managing the business for an extended period of time after it's been sold, which might not be what the client is hoping to achieve. Again, leading on leading on from that, if there are issues in the business, such as size, it might have an impact on how offers from trade buyers are structured. So if it's a small business, it might be difficult to raise a lot of finance towards an acquisition, and therefore offers might be more likely to include a high proportion of deferred consideration, that being money that's paid for the business in the future, funded from the future profits and cash flows of the business. And again, it's important to think about those issues right at the outset, because if your objective is to sell the business to a trade buyer, have a clean break, give a short handover period, and receive all of the proceeds of the sale either at completion or shortly after, then that might not be what is possible. It might be that it's more likely that the vendors would be required to remain with the business for a long period of time and maybe receive the proceeds from the sale over a number of years. There's a few further issues to think about, and those are that is a trade sale the best option? Andrew touched on this in the introduction. Maybe a management buyout would produce a better result for the business owner than a trade sale. And we run a separate webinar specifically on management buyouts, and we regularly undertake work for clients comparing management buyouts to trade sales. As well as the management buyout option is a cash out, a realistic sort of better alternative, being selling a portion of the business to a private equity investor, committing to remain with the business and grow it over a 3, 4, 5 year period, and then looking for an eventual exit in that sort of timescale. And also, it's important to consider the timing of a sale. There could be issues in the business that mean that it's better to wait a year or two before seeking a trade sale. If there's been issues in the business in the recent past that have affected profits, that could be a reason. So obviously we had the pandemic last year. Some businesses have been relatively unaffected. Some have thrived. Some have had temporary issues. It might be that leaving a trade sale until nearer, in the near future might be the best option. The management team within SME businesses is an very important sort of factor when it comes to seeking a trade sale. Ideally, trade buyers would want to have a fully formed second-tier management team that's not reliant on the business owners at all. It might be that your business has is nearly there in terms of a second-tier management team, but just needs to sort of be reorganised slightly, a bit more training given to the managers, and formally sort of make that separation and move from the owners being sort of the executive management to sort of part-time non-executive management. Maybe those sorts of issues need to be addressed before seeking a trade sale. A very, very common issue that we come across is insufficient management information within a company. If it's a successful business that's been operating for many years, which is the kind of businesses that we normally get involved with, the need for accurate, timely management accounts is less important. There's often a lot of cash on the balance sheet, so cash management is less of an issue. The owners are hands-on, know what's going on in the business, and therefore don't need to sort of spend a lot of resource on sort of accurate management information. However, when it comes to selling your business, having reliable, accurate monthly management accounts is incredibly useful, not only for providing information to potential buyers, but also for things like calculating a normalized level of working capital, and that's important when it comes to calculating the surplus cash. So moving on to the final bullet point on that slide, minimizing working capital. If it's possible to reduce the amount of stock that a business is carrying, or reduce the debtor days, or take advantage of more trade credit from suppliers, all those sorts of things. Anything that business owners can do to reduce the amount of working capital in the 12 months leading up to a sale would more than likely lead to a higher sales value. So there's lots and lots of things to consider that I've just talked about when it comes to planning for a sort of an exit and a sale of your business. We really enjoy getting involved with clients' businesses at a very early stage and helping our clients consider those sorts of points. So moving on to the trade sale process itself, just to give you a bit of an idea as to what's involved and the timescales. On average, we tend to find that a trade sale can take around about 9 months from start to finish. And there's 4 sort of broad stages involved. You've got the pre-marketing stage, where after we're instructed to act as lead advisor on a trade sale, we will start to plan the marketing stage and put together the marketing materials that will be required. You've then got the marketing stage itself, when we're going out and looking for buyers, having meetings and soliciting offers. Once offers are received, you then normally have a few weeks actually fine-tuning, or selecting the preferred purchaser, fine-tuning the deal, and getting to signed heads of terms stage. And then once you've agreed a deal in principle, you've got heads of terms, there's then normally another 2 to 3 months needed to actually close the deal, during which time you've got the purchaser conducting their due diligence, and all the legal work is happening to conclude the deal. So start to finish, 9 months. There's a lot of work involved there. I'll talk you through what's involved in a bit more detail over the following slides. So as I mentioned, there's the pre-marketing stage first of all, which we tend to would take several weeks for us to perform on behalf of clients. There's 2 sort of key aspects to this. One is preparing the information memorandum, which is a a key document that would provide potential buyers with detail about the business, why the owners are looking to sell. Most commonly, that would be a sort of retirement sale situation. But if it's not a straightforward retirement, then the reason for the sale would need to be sort of clearly described. A bit about what the business does, the products it sells, the services it supplies, the market it operates in, who its customers and competitors are. Revenues are incredibly important, and being able to sort of demonstrate to potential buyers what's the where revenues are going to come from in the future. So if it's a business where there's a lot of repeat customers are contracted for several years ahead, then that's ideal. Or even if there's a sort of a long track record of repeat business from customers, again, those are all good things to bring into the information memorandum. Details about who's the key people in the business, the management team, how long they've been with it, their qualifications, their skills. Details about the infrastructure, the property, plant and machinery in the business. Opportunities for growth, and again, it's tempting to kind of throw the kitchen sink at describing the opportunities for the business, but it's best to kind of keep those fairly sort of focused and limit it to things that could be implemented quickly, and also explain why they haven't been implemented so far. Usually when we're advising clients, it is retirement situations, and it's common that the owners just haven't wanted to sort of kind of put their sort of time and energy and money into pursuing growth opportunities, understandably, but there could be sort of genuine growth opportunities there for new owners to take advantage of. And finally, financial information about the company, and this is crucial so that buyers can understand what the business is worth, form their own view on valuation, and also prepare indicative offers that can be compared fairly. The aim is to receive several offers from competing potential buyers, and if they've all based their offers on the same information, then you can be sure that the different offers are fairly comparable. And it's important that the information is accurate, and the offers that you receive don't change further down the line because the data that you've given up front in the IM turns out to be inaccurate. So in terms of the level of detail that goes into the information memorandum, there needs to be enough detail in there to allow potential buyers to evaluate the business and put together indicative offers. But at the same time, it's important not to put in sensitive commercial information that could be used against the business, because it is inevitable that some of the readers of the information memorandum may just be being curious and digging for information without a serious interest in purchasing the business. As well as preparing the information memorandum, at the same time, we would be working on a list of potential buyers for the business. And the first stage of this is to think about and profile the ideal strategic buyer. Is it going to be a competitor of the business? Sometimes it is. Sometimes it's better to sort of think beyond immediate competitors and maybe look at companies that may be offering the same sort of products or service, but in a different geographic market. So if we're acting for an engineering business in the Midlands, maybe an engineering business in the southeast or southwest might be the best place to look. Or it could be a company in the same location but offering a slightly different sort of product or service, and where putting the two companies together would form a stronger business with a broader range of products and services. Ideally, in most cases, we're looking for potential buyers that have a track record of successfully making acquisitions, and that way we know that they are serious about growing the business by acquisition. They've done it before, they know what they're doing, and they have the resources needed to carry out acquisitions. So we're thinking about different categories of potential buyers, and then we're actually using a number of research tools to compile firstly a long list of potential buyers that might be 100 or 200 potential companies, and then researching each one on the list and narrowing it down to a short list of those most likely the best quality potential buyers for us to focus our time on and focus our clients' time on at the same time. So the kind of research tools that we have available, we subscribe to a database from Experian, which captures deal activity worldwide. So if we are looking to sell a software business, for instance, we can search this database for any other transaction involving a software business anywhere in the world, and we can limit our search to specific kinds of software business that have a certain keyword or certain sizes of deals, and that's an invaluable resource that means we can sort of narrow down our research to those companies that are actively making acquisitions and are the most suitable potential buyers. As well as the deals database, we have a company's house database, which we can search for companies involved in different sectors. They may not have made an acquisition before, but if they are involved in a particular sector, then we can identify them from that database and add them to the list. And as well as those specialist databases, there's things like just general internet research, industry publications, trade journals, trade websites, and also critically understanding about our clients' markets and the companies in that market directly from our clients. We always say that our clients are the experts in their particular industry. We'll work closely with them to understand their market. We bring the deal knowledge and expertise, but we do sort of lean on our clients for specific industry knowledge relevant to their company. So moving on to the marketing stage, once the IM's prepared, the buyer research list has been completed and agreed with our clients. I should have said on the previous slides, once we've done our research, we would then always sort of sit down with clients, go through the shortlist with them, and make sure that our clients are happy with those companies that we've shortlisted to approach. Moving on to the marketing stage, with the research-based approach, which I've outlined a moment ago, we've got a short list of pre-vetted buyers. One of the advantages of this approach is that it is a very confidential way of going about marketing a company for sale and finding a trade buyer. We're limiting our approaches to a relatively small number of potential buyers, and that way the risk of industry gossip spreading about our client's company being for sale is minimized. The research-based approach also means that we can target international purchasers as well as UK-based buyers, and it tends to that approach tends to be more appropriate for larger businesses where we can be fairly sure that the business will be of interest to the shortlisted buyers that we've identified. There's a second strand to the marketing approach, and that is the advertising sort of method. So rather than relying on a short list of targeted potential buyers. That involves advertising the business confidentially, more wider, using specialized websites. So we also operate our own business sale website called dealopportunities.co.uk. And that features hundreds of businesses for sale at any one time, posted by other corporate finance advisors and agents selling clients' businesses. The advantage of that website is that it does reach an enormous number of potential buyers and people involved in the deal-making industry. So other advisors, business brokers, corporate lawyers, private equity buyers, private investors. So that is a fantastic resource that we can use to market our clients' businesses much wider and reach a much bigger audience. Downside of that approach is that, that there is more risk of confidentiality issues. You're contacting a greater number of potential buyers. Some of those potential buyers may not be as well funded as buyers that we've put on the shortlist and are targeting directly. But the advertising approach is more appropriate for smaller businesses where it's necessary to sort of look for cast the net as widely as possible to look for buyers. And as mentioned at the bottom of that slide, we tend to find that a blend of both those approaches is appropriate for many of our clients. We can carry out some research and focus our efforts on a short list of potential buyers, but supplement that with the advertising-based approach. So in terms of the actual process, when it comes to marketing, we've got our short list of potential buyers. We would contact the key decision makers of each of those shortlisted potential buyers. Ordinarily, that's the managing director of most companies, or if it's a larger business that carries out many acquisitions, it could be they've got a specialist M&A department that we would contact. In the first instance, we would be providing them with an anonymous profile of our client's business. If it is of interest to them, we would invite them to complete and sign a non-disclosure agreement or NDA. And once that NDA is in place, they would be provided with the information memorandum. Once they've received that document, we would follow up with them, and if there's a further interest in taking things further, at that stage we would answer any initial questions they've got about the opportunity, and if appropriate, arrange for them to hold introductory meetings with our clients. And it's at this stage in the process that things become interesting for clients when you get the opportunity to sit down with potential buyers, talk about your business, find out about the potential buyer on the other side of the table, and find out if there's after the initial meeting, you tend to get a good idea as to whether there's a deal to do or not. So you as part of the process, you might have it varies, but you can expect to have half a dozen at least meetings with potential buyers. Following that round of meetings, we would invite buyers to put forward indicative offers, and one of the big advantages with this sort of formal trade sale process is that it does create competitive tension. The buyers we're talking to, they know they're in a competitive process. There's other buyers looking at the opportunity as well, and therefore they need to put forward their best offers to secure the deal. Once indicative offers have been put forward, there would normally then be some further negotiation to improve those offers, and also sort of hone the details of the offer. And following that sort of negotiation process, there's a few weeks to kind of consider and select a preferred purchaser to move forward with. So there's a number of things that we'll be considering with our clients at this stage. Firstly, the price, fairly obviously, but also the structure of the offer. Is the consideration being paid at completion, or is it spread over a number of years? Are there conditions attached to the consideration? Do certain performance targets need to be adhered to either sort of just before or post completion? How deliverable is the offer is a critical thing. If there's two evenly matched offers, but one is from a well-funded business with a track record of making acquisitions, then it can be often be safer to select the more deliverable offer with the more reliable purchaser. And also there's non-financial sort of other non-financial factors to consider as well. The implications for the business and the stakeholders in that business. Usually our clients, as well as wanting to secure a deal that meets their requirements in terms of the proceeds they receive for their shares. That's usually closely followed by wanting to find a buyer that will be a safe pair of hands for their business, that will look after their staff, that they would feel comfortable with introducing them to their customers. And it's those sorts of issues that are also foremost in clients' minds when it comes to considering different offers put forward and selecting which one to move forward with. So there's normally a bit of negotiation around those sort of terms that have been put forward, and the aim at the end of this sort of part of the process would be to reach heads of terms with a preferred buyer, setting out the price, when it's going to be paid, any conditions, and also any adjustments to the price. So normally offers are put forward on a debt and cash-free basis, but it can be a bit of a grey area to determine exactly what that means. So at this stage, we would delve into that and make sure it's clearly understood on both sides and clearly articulated in the heads of terms. The heads of terms would also contain a clause giving the buyer a period of exclusivity during which they would conduct their due diligence and fund any fundraising that's necessary, gain any consents that they need, and conduct the legal work that's needed to complete the deal. The heads of terms, it's best that they need to be detailed and contain all the key terms. However, at the same time, it's important that they're not overcomplicated and they start to go into too great an amount of detail and start to sort of contain things that ought to be left until further in the process that would normally be negotiated by the solicitors acting for both sides. So it's a stage where it does help to have professional support rather than trying to do it yourself, to make sure that those heads of terms do what they're supposed to do, and don't create an additional hurdle that can cause a deal to fall over. Finally, you're into the fourth stage of the process. You've reached a deal in principle, agreed heads of terms with a potential buyer, and then it's the sort of the home stretch and closing the deal. So at this point in the process, buyers would be conducting their due diligence to make sure that they understand what they're buying, and there's no issues in the business that they ought to be aware of. So there's normally at least two strands to this. One is financial due diligence, where the buyers may ask their accountants to look into the recent accounts of the business, and also legal due diligence is always conducted, where the buyer's solicitor would send a long questionnaire to the seller's solicitor, asking for the sellers to give almost endless details about the business concerning all aspects of it. So things from its historic register of directors and statutory matters, through to insurance cover and litigation, environmental consents and compliance, tax history. So that can be quite a long sort of time-consuming process for clients to pull together that information, and it does help to speak to a solicitor at an early stage and get an idea of what kind of information will be required at this stage, so that you can start to prepare in advance and sort of gather that information at an early stage, rather than leaving it until it's required. As well as the due diligence, the solicitors acting for both sides would negotiate an SPA or share purchase agreement covering a wealth of different things, mainly giving protections to the buyer in case there's any issues in the business that they haven't been informed about. That can take several weeks to complete from end to end, and our role at this stage is to make sure that that the process keeps running smoothly, that there's no sort of miscommunication anywhere, and also assisting our clients, solicitors, and giving our advice from a commercial and financial point of view. So this process, as noted on the slide, there is a heavy time commitment for clients at this stage. It can be very stressful. It can be quite an emotional sort of stage in the process, and again, it does pay to have experienced corporate solicitors helping with this, and corporate finance advice to provide that support.
Thanks, Greg. I'm just going to briefly talk about how we can help with the process before we take questions at the end. So if you want to ask a question, now's a good time to ask the question. We'll pick up as many of those as we can at the end of this webinar in a few minutes' time. So in terms of help, we've almost sowed the seeds and talked about what we can do. We're just going into slightly more detail here. So as I said right at the beginning of the seminar, in the introduction, we like to give clients early stage advice, to give clients the benefit of our experience, our knowledge, the benefits of the database searches we can do to see what deal activities in their sector. So we give a lot of early stage advice in terms of the valuation that a client is likely to achieve. And as I said earlier, those valuations tend to be accurate because of the experience we've got in doing deals. So the valuation is part of it. And if the valuation isn't where the client needs it to be, that valuation exercise, the report that we issue, and discussing the report with the client, will give clients guidance as how to change the valuation in terms of if they can improve their profitability, improve the multiple, take other actions that improve the multiple or profitability. A few small changes can actually make quite a big difference to the valuation that can be achieved. So the valuation, it might not be where you want it to be, but it can be seen as giving you almost a roadmap of ideas as to how to change the valuation to get it where you wish it to be. But at least our valuations are accurate, and the client then embarks on the sale process knowing what is realistic. Yes, we'll try and beat the valuation. We'll try and get a bit more than that. We'll try and negotiate hard, spend a lot of time looking for buyers to get to beat the valuation. But typically the deals we conclude, they're often sort of 10%, maybe 15%, maybe 5% above the valuation we gave in the first place. The valuations are fairly accurate, although slightly on the cautious side. If a client's looking at both an MBO and a trade sale, we can talk about how the valuations could be different through an MBO and through a trade sale. And through an MBO, it is often due to the client reinvesting into equity in the new holding company for almost a nominal cost. Can be very helpful in giving extra value to clients. But valuations can be different under an MBO and trade sale, and can be higher under trade sale and can be higher under management buyout, depending on the circumstances. So we'll look at deal activity if it's likely to be a trade sale. We'll talk about saleability issues that could harm the saleability, and we'll compare with an MBO where that's appropriate for the client. So really, we really believe that early stage advice to allow clients to have clarity as to what can be achieved, have clarity on the different exit routes. So right at the start, they make the right decision as to the exit route to take and know where it's likely to lead. It's very important advice. We then get on to the main part of the process when a client is ready to do a trade sale, or it can be an MBO, which we talk about in a different seminar. But assuming that we're talking here about a trade sale, starting the process, and Greg's taken us through preparing the information memorandums, doing the buyer research. We're here really to take a client through the process from the start to the finish, recognizing that most clients will do a sale once in their life. And we'll work very closely with our clients. We'll work very closely with their solicitors and their accountants. It's a team effort. We'll lead it. We'll do most of the project management. We'll drive it forwards. But it really is a team effort where all the professionals working very closely and working well with their client allows the best results to be achieved. We'll deal with issues as they arise. We'll often be able to forecast that there may be issues in advance. It's much easier to deal with issues before they become an issue. We don't like hiding bad news from buyers. If there are weaknesses in the business or issues, we like to address those absolutely upfront with buyers, so there's no shocks later, and talk about why they're not big issues, how they've been overcome, what has been done to make the issues less of an issue. But no shocks later. Offers that have been put forward can be withdrawn at that stage or renegotiated. We don't want that. Our experience is, because of our approach, the way that we are forthcoming with purchases and cover the good points as well as any weaknesses, we tend to find when we've negotiated deals at heads of terms, it's quite rare for buyers to find an excuse later on to try and renegotiate the deal. We want to deliver the heads of terms, the deal and the heads of terms, and not have to renegotiate to a deal that's not as good later. We managed to avoid that in nearly all cases. Our job's really to make the deal happen. The slogan is making the deal happen, but not at any cost, where the deal is right for the client and nearly always right for the business as well. Most clients see that as very important, as Greg has said, that the deal has to be right for the business, for the employees, for the customers, as well as for the client. So that's how we can help. Very, very happy to talk to any of you over the next few weeks about how we can work with you to understand your businesses in more detail and have a chat about how we can help. No cost, no obligation meetings. We're doing most of our meetings by Zoom at the moment, which we're finding potential clients like, as well as ourselves. It cuts down on traveling time and seems to work very well. So if you would like an initial chat by Zoom or just by phone, Catherine will be in touch and very happy to do that. So at this stage, we're going to take questions. So Catherine is going to join us and Greg's going to join us, but Catherine's going to lead us through the questions that have been asked. And I think one or two came in earlier by email before the webinar started as well.
Yeah, thanks, Andrew. Hello, everybody. The first question, picking up on something that was mentioned earlier on in the webinar on company valuation. The question was, how does minimising working capital increase the sale price?
Thanks, Catherine. Yeah, I probably didn't explain this fully when I was talking, but yeah, I mean, basically, when we're acting for clients' businesses, they will normally have a sort of accumulated cash reserves on their balance sheets, and part of that cash would be needed to help run the day-to-day sort of the business day-to-day, to sort of pay suppliers and staff, etc. But then usually most of that cash is surplus to requirements and could be extracted from the business as dividends, but normally would remain in the business and just be added to the price on a pound for pound basis and extracted and from the business in that way, increasing the sale price. That how this sort of interacts with working capital is that the lower the amount of net working capital in the business, it just means there's more, less cash is needed for working capital, and more is surplus cash, and therefore there'll be more money to add to the price. So if you think about it, if your business is taking 30 days trade credit from suppliers, but then you could change suppliers and take 50 days trade credits, then that would lead to more cash being left in the company bank accounts. That would add to the surplus cash and add to the price that you'd receive for the business. I've probably not explained that very clearly at all, but that's the
Do a separate webinar on this topic, but there is a potential there. If you've been running your business and you've got a lot of stock, let's say you've got £900,000 in stock, and 300,000 that turns over very quickly and is needed, and the other 600,000 sits there and it's not sold on a very regular basis. If you could flog off that 600,000, albeit you might not get full value for it, if you can flog it off and just run your business with the 300,000 that's needed to run the business for the normal level of sales, you've turned that 600,000 of stock into some cash that will be surplus cash when you come to do the deal. If you can collect your trade debtors in 60 days when you've been collecting them in 75 days and keep it at 60 days, then again it's turned trade debtors into more cash, and the cash that isn't needed for working capital is surplus cash, gets added pound for pound to the purchase price, as Greg has said. It almost needs talking to, we're happy to talk this on a one-to-one basis to look at your business circumstances and advise you on your business circumstances. But we do see businesses from time to time where there's a massive opportunity to take a couple of years to rethink their working capital approach, get their working capital down, unwind stock and trade debtors into cash, and it can make quite a big difference for certain businesses, particularly those in modest profitability, to the ultimate purchase price that you get.
Okay, thanks, Andrew, and thanks, Greg, there as well. The next question, what's your success rate for selling companies?
We aim for 100%, and we get pretty close to it. We're a small team. We earn our fees. We charge monthly retainers, but they're quite a small part of our total fees. Most of our fees are based on a success basis, where that element of our fee is paid when the deal completes. So we need, as a team, we need deals to complete as our clients need the deals to complete. So we work very hard to complete every deal that we win, and we achieve almost 100%. We achieve that in different ways. We achieve it partly because we won't take on clients who've got unrealistic aspirations that can't be met. So if we feel your business is worth 1.75 million, you tell us you won't sell for more than £3 million, that's not one we'd act on, because you're going to be disappointed. If we take that on, you'll think that we really believe we've got a slight chance of achieving it, and it's not achievable. So we act for clients who have got, we don't mind having ambitious aspirations from time to time. We'll make it clear to a client where we think their aspirations are ambitious, but we act for clients who have aspirations in value that can be delivered. And we, at an early stage, will identify any issues that could affect the saleability of the business, and we'll discuss those with clients, and it's best for those issues to be addressed before we put the business on the market. So we're working with clients really. Once a client, the other point I'd mention is it's a mindset. Once you have changed your mindset that you don't want to continue and you want to exit the business and do something else with your life, your mindset has changed and you've almost moved on in your mind. Failure is not an option. We need to keep working and be persistent to get you the option you need to be able to exit. So we get pretty close to 100%. The ones that don't get away are usually where the trading performance has been hit. So we've started acting for clients and the trading performance has dipped significantly. The order book has shrunk dramatically. And even with those, we'd talk to clients, suggest we pause the transaction, they trade for the next 6, 12, 18 months, and then we pick it up again. We've done a number of deals where we've picked it up 12, 18 months later, and actually it's focused the client's mind and they've improved their business during that period. So we've ended up getting a higher valuation than we expected at the start of the process because of the changes made to the business and its profitability and its the risks in the business, and we end up getting better deals. So the short answer is we do get pretty close to 100%, partly through persistence, partly through I suppose vetting clients that we take on, but there's very few clients that we don't take on. Most clients are realistic about once we've talked about the valuation and deal activity, and shown them how the business should be valued, most clients are realistic about what can be achieved. So most clients we meet, we do work for, and we do achieve a successful exit.
That's great. Thanks, Andrew. Got one more question here. So if there is anything you'd like to ask, then please put the question in the Q&A whilst this last one's being answered. And that question is, what's the current climate like for selling a business?
Greg, do you want to take that?
Yeah, I think it's very, very good at the moment. I think we were concerned, or very concerned this time last year as to how coronavirus was going to impact the M&A market, and certainly there was a lull for 3 or 4 months, sort of last spring and summer, when there was very, very little activity going on. But since the end of the summer last year, there's been a lot of activity. There's lots of people wanting to do deals and buy businesses, and yeah, I think that the market's come back really, really strongly. Obviously, there's some areas of the economy that have been badly affected and still are in sort of tourism and hospitality, but in our experience, most of the kind of clients that we work for are sort of B2B businesses, and they may have had some disruption last year, but by and large things are returning to normal. There's a helpful funding environment at the moment. The government's coronavirus business loans response has helped provide some additional liquidity for trade buyers to help do deals, which is helping. And there's also the driver from speculation around capital gains tax rates increasing in the near future, which is also sort of driving a lot of business owners to think about selling their business later this year.
Yeah, I think overall we're finding the activity levels buoyant. I know the corporate lawyers are busy as well at the moment. So yeah, it's almost counterintuitive to what you might expect. But we're also finding of the businesses we talk to, there's a lot of them that have actually benefited from COVID over the last 12 months and seen an uplift in sales and profitability. We're seeing a number of businesses who obviously went through quite a tough time in March, April, May last year, and then started taking staff off furlough and found that they had some dead wood and they could actually slim down the workforce and achieve the same results without taking everybody back from furlough, and are now much more profitable. But overall, there's a lot of deal activity at the moment, and for the reasons Greg has given, we see that continuing.
Great, thanks both of you. That's all the questions for now.
Yeah, thanks for listening. If anybody, Catherine will follow up and offer you the opportunity to have a meeting by Zoom or Microsoft Teams, so we can talk about your specific businesses in detail. Welcome the opportunity to do that. We do record these webinars, so if you've missed any of it or joined late and want to watch the webinar from the start, just let Catherine know when she emails you and she'll send you the link. It'll be up on YouTube from tomorrow at some stage. We have got other webinars coming up, specifically one on company valuations, one on management buyouts, and one, as I said earlier, on comparing trade sales with management buyouts, looking at the pros and cons of each. You're welcome to attend any of those webinars, or again, if you want to see them before the next schedule, get in touch with Catherine and she'll give you the link for the last time we ran one where the recording's on YouTube. So thank you very much for listening, and hopefully we'll get to meet most of you soon. Thank you very much. I'm going to end the webinar now.